Okay, so we've got the on button there. We will start the streaming as well, and it is connecting me. So we will get started. Okay, so let me minimize this. Okay. Oh, okay. So let me unshare that one. We don't need that screen yet, just getting that going there. Okay. Hello, everybody. My name is Hung Lu, and we will get started with Money Matters. Okay, so in today's 30 to 45 minutes, we will look at analyzing a deal, some calculations, and then I will also answer any real estate questions that came through in the last week or two. So, all right, so before we go into the analysis, we have a book. Okay, so I haven't done this before. So this is one of the books that I've written called The Secret to Wealth with Brian Tracy. In this book has over 50 real estate investors. We collaborated on this book, and we each wrote a short chapter on the strategies that we're doing within real estate, what we think about real estate, some of the concepts in real estate. So this is a book full of knowledge, okay? And so I will be gifting this book to anybody, a physical book, so I actually have to mail it to you. Okay, and this is a heavy book, okay? So if you would like a copy of this book, all you have to do is either book a complimentary phone call with me, which you can do from clicking on my online calendar, okay? Or you can send me a question that you have about real estate. So there's two ways to get the book, okay? So one is either booking a complimentary phone call or sending me a question that you want answered in real estate, and that's it. Okay, and so then I will be mailing you out a physical copy. If you want an e-version, I can do that too, because I do have the e-version copy of this book. Okay, so that is the little pitch for this wonderful book. Okay, so that is the book. Okay, so the disclaimer, yes. So before you implement any of the stuff that I share with you, just keep in mind, these are my ideas, the stuff that I'm doing because it's right for me. And, I'm learning as well in my real estate journey. So before you implement any of the stuff, please go and speak to your lawyer, accountant, financial advisor, all that wonderful stuff. Okay, so today, what we're going to talk about from an analysis point of view, what I want to share with you is about capital stack and okay, so I'll explain it to you, sharing a spreadsheet, because understanding how a capital stack works is important in the sense that you want to know where you are in terms of getting your money back, either from doing like a private lending, a VTB, but also if you're going to be doing GPLP. Okay, so if you're getting into capital raising, if you're doing joint ventures, you want to understand how capital stack works. It's the same thing as a debt stack. Okay, so I'm using those two terms interchangeably. So let's go through this example here. So I built out the spreadsheet this morning because I wanted to use sort of like a clean sheet rather than the calculation sheet that I use when I'm doing a deal analysis, just to make it, I'm hoping that it'll be a little bit easier for you to follow how this capital stack works. So the reason why you want to understand this is because depending on if you're mortgage 1, mortgage 2, or mortgage 3, that is an indication of when you're going to get your money back and the level of risk that you have in the deal. Okay. On the other side of the spreadsheet, I've got what's a capital stack. So this is where it's the same idea, right? So instead of saying mortgages, we're saying, okay, well, the construction loan is going to be in position 1, similar to a mortgage 1. Legals and accounting and expenses will usually get paid out second, which is similar to a second mortgage. The private, so any private money. So here we're talking about the same thing for like a mortgage 2 or mortgage 3. Usually those are private money. Okay, so we'll talk a little bit more about that. Those will get paid out next. And then the LPs will get paid out. So the limited partners will get paid out after. And then in the last position is your GPs. Okay, so the general partners, the active partners, those will usually get paid out last. So as you can see, you're basically stacking it. So first, second, third, fourth. Okay. Now I sort of like to look at it from the top down. After we go through this, I'll go through a drawing, and it's going to be from the bottom up, so you can sort of visualize it that way. You know, I know that people learn in different styles, and so I'm going to see if I can cover both of those today. Okay. So in terms of a debt stack, okay, or a capital stack, let's just say, for example, we have, okay, and I'm trying to explain this as big as like to cover all the angles here. So if you're going to be buying a property or an asset for $1 million, okay, you have either the market value or the appraised value. Okay, those are not the same thing. So let's just say you go and you put in an offer and it's $1 million. Okay, well, the bank's going to send their appraisal out, and they're going to come back with an appraised value. Okay, so now let's just say it's $1 million on the market, but the bank's going to appraise it at 950. Okay. The reason why this is important, because the banks are not going to lend you to the million, they're going to lend you based on the 950. Okay. And this has been an important thing over the last couple of years, because a lot of individuals who are buying properties, they put in their value at, you know, the 1 million, and then the banks are coming back and saying, no, Huong, the property's only worth 950. So we're going to lend you 950 or up to 950. Okay. And then you need to come up with the extra that's missing. So that 50,000 that's missing, you have to come up with that. So over the last couple of years, the private lending has been there's been more of a need for private lending because of that shortfall. That bridging needs to be captured somewhere. And a lot of people don't have 50,000 just extra sitting in their bank account, or 200,000 sitting in their bank account, which is, you know, what I've seen in the last couple of years. Okay. So when you go and you structure your debt or your capital, you're going to need to have some sort of equity in. So that's usually the down payment portion. Okay, so in this case, I'm using 25%. So that means that you're going to be tying up $237,500 in your deal here, okay, in your opportunity. So that means that your total loan needed is $712,500, okay? So this is, at this point, just math, and this is very easy to calculate. Okay, so what you're doing is you're just taking the difference of your 950, okay, minus your down payment, and that's going to get your total loans that you need. Okay, so if you can go to the bank and get one mortgage, well, then your total mortgage is going to be the 712. Okay, so keep in mind that there could also be what's called the city assessed value. Okay, so there's the city assessed value. Okay, so in this case, I'm just touching on it, but I'm not going to do any of the calculations based on the city assessed value. The city assessed value will be a completely different number. It may not even be the market, and it may not even be the appraised. Okay, in Toronto and Vancouver, we see the city assessed value being, you know, maybe 80% of the appraisal, you know, 75% of the appraisal. It's however the city assesses it. Okay, and so that is a completely different number. Some lenders will be like, hey, you know what, we're going to lend you based on the lesser of the two numbers of the appraisal and the city assess, which totally sucks if you're trying to get as much of the leverage as possible. Okay, so here I've just put in the amortization for 25 years, 6% rate. Okay, this is sort of like the norm right now. If you're doing multifamilies or other business, other asset classes, you're going to have a different amortization. So at this point, just for this example, we're using a 25% amortization. Okay, so I'm just showing an example here of saying, okay, let's just say you can go and you get the first mortgage is $500,000. Okay, so your monthly payments usually in first position is going to be principal and interest. Okay, so the calculation here, I want to walk through this calculation because this is a hard calculation to do in Excel if you don't understand it. Okay, and this is important to understand how this is principal and interest, because what happens is when you go to do your mortgage 2 and your mortgage 3, similar in the capital stack, usually those are interest only, meaning that you're not making a dent in the mortgage paydown. Okay, it is only interest, meaning that you're just paying interest. So if your mortgage on a private lend is 150. At the end of that 1 year, you still owe them 150 because you've only just paid them interest. Like you haven't hit any of the mortgage pay down. Okay. So let's just say in the mortgage one, to calculate principal and interest, it's a simple formula. And if you understand the formula, then you'll be able to do this principal pay down calculation very easily. So you always put a negative at the front. And then because it's a payment, so it's a negative, it's an outgoing, it's an expense. So we put a negative number in there because we actually want to see what the positive number is. If you don't put the negative, it's the negative dash, it's going to give you a negative number. So then you just have to understand, okay, well, it's an expense going out. That's why it's a negative number. Okay, I hope that makes sense. Okay, so you know what? Let me take that out and you'll see. So right now, with it being in there, that negative dash, you can see that the monthly principal and interest payment is $3,221. So if I take that out, it's the exact same thing. Okay, so it's basically a minus number. Okay, so I like to look at it as a positive number so that I know it's money going out. Okay, so then what happens is, so that's your principal and interest. So the way to calculate that is you're taking, in this case, your interest rate, okay, divide that by 12. Okay, you're always going to divide it by 12. Okay, so whatever your interest rate is that you're going to get from the bank. So in this case, we're using 6%. Okay, 6% divided by 12. Then the next number that you're going to put in there is your amortization. Okay, so I'm using 25 years. If you increase your amortization, your monthly payments are going to be less. Okay, that's not necessarily a good thing because what happens is if your amortization is longer, it's going to take you longer to pay off that entire mortgage, which means longer for passive appreciation and also equity buildup and mortgage pay down. Okay, so it affects all of those things. Okay, so ideally you want to pay down the mortgage as much as possible, as fast as possible, so that you can get that cash out and then go leverage it somewhere else. Okay, now if your rate is super, super low, like 1-2%, okay, well then maybe you do want your amortization as long as possible because that's like cheap money. Okay, so a couple of things there. So then, okay, so that is your K9, which is your amortization times 12. Okay, and then the next number that you're going to use is the actual mortgage amount. So in this case, we're saying the first mortgage is going to be $500,000. If you're only going to have the one mortgage and you're not going to have the second or the third, then your $500,000 here would actually be your 712. Okay, so you can adjust that number yourself. And then the 0 just means that by the end of it, I'm not going to owe any money. Okay, so that's how that formula works for your principal and interest. Okay, so this mortgage one is considered first position, meaning that if something happens to your property, they're going to be the ones to get paid out first. Okay, which is really important to understand when you're doing private lending and if you're doing one of these like a capital stack. Okay, so now, so as you can see here, if you get the first mortgage for 500, you still have 212,000 left over that you still need to give to the seller. Okay, so in this case, we're saying, okay, let's get a second mortgage for 150. We're going to go to a private lender and pay 10%. Okay, private lending is not cheap money. So, you know, I get a lot of calls from people saying, hey, Huong, you know, I'm looking for 300,000 and I want it at 6%. I'm like, okay, go somewhere else. Okay, because private lending it's for people who understand that, one, there's a cost to doing business, and two, you know, your asset that you're buying should be making you way more than 10-12%. If it's not making you at least 15-18% minimum, it's probably not a great deal. Okay, so here we're gonna do a second mortgage at 150. So the interest calculation only, so interest only payments, meaning that by the end of the first year, because keep in mind, private lending really should be short term, 6 months, 1 year, 2 years at the most. It shouldn't be long term. Okay, The way to calculate that is you just take the amount that you're borrowing times the rate divided by 12, because every single month you're going to pay that. Okay, so this is monthly payments. That's why you're dividing it by 12. Okay, so that's $1,250 that you're going to be paying. Okay, so now this is going to be in second position. Okay, so meaning that it's going to come after the first position lender. So there's still 62,500 left over. So this is going to be in a third mortgage, third position. This is not an ideal place to be in. Okay, if you're doing private lending and you're getting into private lending, third position is not something that I would recommend you do unless it's somebody that you trust significantly, like a lot. Even if it's family member, it's not something that I would recommend. Okay, so third mortgage position. So in this case, it's 62,000 that you need. Look at this, 15%. Usually third position mortgages are higher than the second position, and those are higher than the first position. Okay, so this is going to be the same thing, interest only payments. Okay, so you take your amount that you're borrowing, 62,000, times the 15% divided by 12, and that's going to be your monthly payments. Okay, so in total, when you add up all of the monthly payments, okay, you're going to be at $5,252. That's how much you have to make sure you have available to pay out every single month. Okay, so if you're looking at buying an asset worth about $1 million, you need to make sure that the rental income, parking income, any sort of like business income, any of that income that's associated with that asset needs to cover this 5,252 plus all of their other expenses, property taxes, insurance, property management, all the accounting, all the legal, all the fees, every single expense that goes out, plus your mortgage, okay, needs to be covered with whatever that income potential is on this building. Okay, so the reason why I sort of explained that part is because the cap rate is different from your cash flow. Those are two indicators of your deal. It will tell you whether or not your opportunity is good. It's two numbers that you need to look at. Okay, they're related, but they're not the same thing. Okay, so they don't mean the same thing. Okay, so cash flow is whatever your income is minus your monthly expenses, including your debt. So let's just say here your monthly cash flow, sorry, not your cash flow yet. So this is your gross income. Okay, so the gross income from your opportunity per month. Okay, so I'm going to say per month. Let's just say it's 20,000. Right. Okay, so we're going to go 20,000. So this is just an example. Okay, and then let's just say all your other expenses, not including your debt service here, all of your expenses. Okay, let's just say it's, I don't know, 8,000. Is that right? $8,000. Okay, and this is per month. Okay, so that means, okay, that your cash flow per month, okay, is going to be your gross income minus your expenses minus your debt service ratio. Okay, so your debt servicing. Okay, so that means that you're actually going to make a cash flow of $6,700, which is fantastic, and that's per month. Okay, so this now is one indication. Now, if you're buying a property, let's say for $1 million, let's say multifamily. Okay, let's go to the Edmonton market. Okay, in Edmonton, you're probably going to get, let me see here, $1 million. Okay, so let's just say you could probably get 10 units for $1 million times 1,500 in rent, let's just say. Okay, so you're looking at about 1,500. Your expenses, yeah, probably about that. So then your cash flow is going to be that. Okay, so now your cap rate for Edmonton is maybe around 7% right now. Okay, so I'm just going to put cap rate here. Okay, so that's, so your cash flow is one number, your cap rate's another number. Okay, so what the cap rate's going to do is just tell you okay? If you're overpaying or underpaying for your property based on your cap rate, okay? Based on your gross income minus your expenses, which is your NOI. Okay, so let's do that quick calculation. So now we're going to say we want the value. Okay, and if you're trying to figure out what I'm getting at here, because I know I'm going off on a bit of a tangent here, remember the concept of Uncle Vic. Okay, so the value is equals I divided by C. Okay, so this is not going to report well out there. Okay, so your NOI is going to be your gross income minus your expenses. Okay, we're going to put those in bracket. Okay, and then we're going to divide that by the cap rate. Okay, so do I have $1 million now? Let's see. Nope. Why is that? Oh, so this NOI needs to times it by 12. Okay, so there we go. So this property is actually worth about 2 million. So that's a total steal. Like if it's worth about 2 million, and if you can get it for $1 million, you're getting it like on less than 50 cents on the dollars. That's fantastic. So what that tells me is that this income is probably a little bit too high. So I'm going to go back here and let's just say it's $1,000. And instead of 10 units, we have 8 units. Okay. So as you can see now, at a 7% cap rate, the building's worth about 1.25. Okay. So you're still getting the building at with built-in equity, which is good. So you're still getting a great deal here because you're buying it for 1 million and it's worth about 1.2. Okay. Now the problem is that you're negative cash flowing because of all of this debt servicing. Okay, so your cash flow includes your debt servicing. So that's the thing to remember there. Okay, so then let's just say, for example, you don't have any private lending here at 10%. Okay, so we're at 15%. So your second mortgage goes down to 0. I'm going to go back here and leave that. I'm going to go 0 here on the second mortgage, and I'm going to increase this to match this mortgage loan. Okay, so now instead of paying 5,500 for the mortgage, I'm only paying 4,500. Okay, so as you can see, we're still negative cash flowing. Okay, so this is not a great it's not a good position to be in. Okay, so what happens is when interest rates were really, really low, and if you can get a property through CMHC on their MLI Select or whatever, you know, sometimes investors were getting it at 3%, and they were getting a 50-year amortization. Okay, so then as you can see, if you adjust those, now your monthly interest, principal and interest is, your monthly mortgage payment is 2,294. Okay, so you see a huge, it's like, that's a huge difference. Okay, but you're still negative cash flowing. Okay, but your property value is still 1.2. Okay. Okay, so that is, okay, so I'm going to stop there. Okay, I totally, went off on a tangent, so I do apologize for that. So this is how capital stack or debt stacking would work. So let me show you how this would work, not just from looking at it from a numbers point of view, but looking at it from where is my share button here? Okay, so I'm going to do a new share and I'm going to draw out. Can I do that? Yeah, let's go to the whiteboard. Okay, so, okay, so I'm going to unshare because for some reason it's not, there we go. Okay, so here we are. We are in the whiteboard. Okay, we got that. Okay, so if you buy your house here, okay, so there's your house. If it's worth 1 million at this point, okay, so then when you get your first mortgage, depending on, the value of that first mortgage, so this is your first mortgage, okay, then what's going to happen is you're going to get a second mortgage, okay, and that's going to be over here. So that's your capital stack, okay? And then if you happen to get a third mortgage, okay, so you as the investor getting the third mortgage, that's okay. But you as the person putting in the money, I would not suggest doing a third mortgage, okay? So there's two sets of hats that you could be wearing when you're talking about a scenario like this, okay? And then anything above that is what you would call your equity, okay? So this part here is your equity here, okay? So this would be your down payment. This would be your mortgage pay down over the years, okay? Because what's going to happen is if something goes wrong, the first gets paid out first, okay? The second gets paid out, and the third then gets paid out. Okay, so let's take this a little bit further and see what would happen if something went wrong, and let's just say the property now goes down to 800,000. Okay, so in the example here, okay, so let's just say a recession hits, the value's not, the value is, the property was overvalued, you know, for whatever the reason, right? So now the property's gone down to 800,000. Okay, so remember in the first example that we had, we said that the first mortgage here was 500,000. Okay, so let's just say for some reason, okay, the property value went down. So then the second mortgage was 150. Okay, so this here right now is equal to 650 here. Okay, so that means, so let me bring up the other sheet here because I can't remember what the numbers were that we used here. So we're going to say 25. I'm going to go back to 25. This was at 6, and this was 500,000 to 3. Okay, and this was 150 that we used here. Okay, so we had 150 there. Okay, so the 62.5. Okay, so then when we go to the 62.5, okay, so then the third position mortgage is still okay because they're at 62.5. Okay, so all of this added up is still less than your 800,000. Okay, but what happens with this 800,000 now is that means that your equity is less. Okay, because the first is going to get their 500, the second is going to get their 150, and the third will get their 65. So your equity has gone down. Okay, so now let's run another scenario, and let's just say that the property value for some reason goes to 600,000. Okay, this would be very bad. But we have seen this in some places like in Fort Mac. Okay, in Saskatchewan, there have been some opportunities where they literally dropped significantly, dropped by 40% because of it being overassessed. The market's gone down, the economy's gone down, the town that it was in completely went into 100% recession. Like we've seen that before. So it's not unheard of. It's not, you know, it's not something that you want to be having to deal with. Okay, so let's just say that it drops to 600,000. Okay, so the first position is still okay. So they're going to get their full 500,000 back. Now, the second position, there's only 100K left here. Okay, so they will get the 100K. Okay, the third position, they get nothing. Okay, now your equity, you get absolutely nothing. Okay, so this is why the debt stack, the capital stack, is really important to understand. Okay, so you want to run the risk and say, okay, is there ever a risk that it's going to hit this level? Because if it hits this, you don't want to be in third position. Okay, and you don't want to, you know, work or be involved, have sweat equity in this if your equity over time is ever going to be diminished like this. Okay, so let's stop here for all of the examples. All right, so let me stop the sharing on everything. So hopefully that got shared properly. Okay, so that actually, okay, so we will leave that calculation and move on from there. Okay, so one of the, so that actually answers a private lending question that came through about investing out of town. So let me answer that question a little bit more about doing private lending out of country. Okay, so we're in Canada now, and private lending is different depending on the province that you're in. Okay, that's right. Okay, you heard me correctly. Private lending is not the same in Ontario and in BC. It's actually very different. Okay, so if you're in one province and you're looking at doing private lending in another province, make sure you understand what the differences are in the different provinces. So a question came through about doing private lending out of Canada. Okay, I only do private lending in Canada. The reason for that is because there's already so many opportunities within Canada to do private lending. You don't need to go outside of Canada. Okay, so that's the first position, the first argument that I would have about somebody saying, hey, Huong, you know what? Well, how about you do some private lending outside of Canada, right? I'm like, no. Why take that unnecessary risk by investing or doing private lending in another country where you don't have the experience, you don't know the market as well, okay, and you don't potentially maybe know the people, okay, the asset class, etc. Like there's already so much risk associated with private lending. Why take that unnecessary risk and invest outside of Canada? Okay, so if somebody's looking at asking you to invest in their project in the US as a private lender, make sure you understand second and third positions, okay? Because the rules change from state to state and from country to country, okay? And, yeah, there's just so much more risk going out of country, so that I would just say don't even do it. Okay, so my next question that came through, it was more of a debate, and it's actually a very worthwhile question to look into. Okay, so in Canada, we have different markets, and so some places have more appreciation than other places. So for Toronto, Vancouver, we've seen appreciations of 10, 15, 25%, depending on where you are, okay? And in some other provinces in Canada, we have maybe 3%, maybe 5% appreciation, okay? And once I started heavily getting into real estate, people were always telling me, Hung, you can't count on appreciation. Appreciation is a nice to have. It's gravy on top of your asset. If it performs well, you want to make sure that, that the next part is having the appreciation. Like you can't count on it, okay? So the argument is that cash flow is king. Cash flow is the best thing. You want to always make sure that you're getting tons of cash flow. Okay. So here's the situation, right? Let's just say you have a property in Toronto, great appreciation, okay? A duplex, a single family is worth about, $1 million in Toronto right now. Okay. But the cash flow sucks. Okay. But if you've had this property for, 5 years, 10 years, you would have gotten a decent enough mortgage. You may be in a position now where you are cash flowing, okay, or at least break even on that. Okay. So now you have appreciation, significant appreciation, because it's the Toronto market. The great thing about that is that you can turn around, refinance, go to the bank, okay, pull out that equity, okay? That equity is tax-free. Okay, now you heard me right, tax-free. So if your property went up by 100,000 and you can tap into that 100,000, you pull that out completely tax-free. Okay, that means if you're in the 30% tax bracket, you just saved $30,000. Okay, that's huge. Okay, then you take that 100,000 and you go and leverage it and do another investment. Okay, so this is where that disclaimer comes in. Okay, before you implement any of the stuff I'm suggesting here, you need to make sure that you talk to another investor, talk to your lawyer accountant. Okay, so now the complete opposite end of that, which is where the debate was coming from, is let's just say you buy a property, it's worth $1 million in a town or a city that doesn't have as big of an appreciation, okay? And we saw that in Alberta for a very long time. There was like like 7 or 8 years in the Alberta market where there was no appreciation. Like basically you bought a property for $1 million today, it's $1 million in 7 years. Okay, like no appreciation. Okay. So those properties though are cash flowing. So meaning you're making maybe $3,000 a month, okay, after all expenses and everything. Okay. So that's good. So now the debate is, do you want the $1 million property in Edmonton or Alberta, making you $3,000, or do you want the property in, let's say, Toronto or Vancouver that is maybe negative, cash flowing a little bit, break even, okay, but the appreciation's going up and up and up, okay? So to answer that question, it's a bit of a complicated question, and it really depends on where you are financially in like your overall net worth, where you are financially. It also depends on your long-term goals, right? Like where do you want to be in 10 years? Where do you want to be in 20 years? Okay. The reason why that plays in is because if you are looking at offloading that asset at some point, you want it to be in a place where you can easily sell it. Okay. If you're in like a secondary or tertiary market, you're not going to liquidate that asset as quickly. Okay. And you're only going to see $1 million. Okay. Because it's in a secondary or tertiary market. But if you're in a primary market and it's, the industry is doing good, potentially you're going to offload it a lot easier. Okay. And you would have seen all that appreciation, that passive appreciation year over year over year. Okay. So the cash flow is great, but keep in mind the cash flow, you're taxed on that now. Okay. The other thing to look at is that a lot of times when people get, 1,000, 2,000, 5,000, they use that to cover other expenses. They use that to buy doodads. They're not able to leverage that money like if they were to get a big 100K check for these other buildings in high appreciation markets. Because when you get a 100K check, okay, you're going and leveraging that, either paying off a huge chunk of like another debt, like a line of credit or credit cards or something like that, or you take that and you put that into another property right away because it's 100K, right? Like because there's significant chunks of money there. Okay. So there's a lot of things to consider when you're debating, hey, is it better to buy for appreciation or better to buy for cash flow? Okay. My easy answer is make sure you're at least break even. Make sure you have enough cash from other sources to cover that break even or that negative cash flow. But I would still prefer to buy in a city that has cash flow and I know has a higher chance of appreciation. Okay, I understand that it's nice to have and it's gravy. But if I know that, hey, I can make this, similar cash flow from that money and still have the appreciation, I would rather both of them. Okay, we will end it there. Okay. All right. Thank you for watching. Just another reminder, if you would like a copy of this book, please send me a question that you would like answered on these calls, or book a time with us and we can talk specifically about your real estate journey, and I will get you a copy of this book. All right. Thank you very much for watching. Have an awesome week, you guys. Bye-bye.